Welcome to Bloomberg Technology. I'm Emily Chang, currently sheltering in place in San Francisco. Markets up across the board despite dismal jobs numbers. And the bond market, a different story. Still, 20 million Americans lost their jobs in April. 33 million have lost their jobs in just the last 7 weeks. Still, President Trump saying he's in no hurry to pass additional measures to prop up the economy. I want to bring in our Bloomberg Markets reporter, Taylor Riggs, who's been diving into all of it. Taylor, tech has been the winner of the week, really boosting the rest of the markets higher. Where do you see the strengths?
Yeah, it is unbelievable that the S&P 500 Tech Index was the second best performer this week, lagging only energy, and it was up 6.5%. I would note that you mentioned some of the dismal economic data that we're getting this morning. Tech and really the markets overall are looking past this and really looking to a lot of hope and optimism, perhaps thinking that the worst is behind us. You hear, for example, this week, companies like Uber said that they're already seeing green shoots in their demand recovery. Zillow saying that people are on their sites. They do want to buy and sell all of these homes. It was notable, though, today, Emily, that tech did not lead the gains. It underperformed some of the broader averages. Still up until this point, the NASDAQ is now the highest going back since February. So despite a little bit of the underperformance today relative to the major averages, I continue to be really surprised at the resiliency of the tech sector.
But what about bonds? Why do we see such a different picture there?
Yeah, so the two-year yield hit a record low of 10 basis points at one point today. We ended up the day coming off that low a little bit, about 15 basis points or so. But the bond markets are giving us a little bit more of an ominous sign about what's really going on inside that economic data than the equity markets, than the tech sector. I will also note that the markets are pricing in a negative federal funds rate. Now, Jay Powell, who's running the central bank, has said that he doesn't want negative rates. He doesn't see it as helpful, but the markets, frankly, do not believe him. So we're looking at what could be negative fund rates, at least by the market's perspective, pricing that in the next 12 months. I'll lead you from a quote from Scott Minerd. He's over at Guggenheim Securities. He tweeted out that a two-year note trading at around 10 basis points signals that the market believes the policy rate is stuck at zero, and the risk is that treasuries will soon be negative. So clearly, the bond markets are telling us a much different story than the tech markets, even the broader equity markets are telling us, at least today.
Meantime, there still is a lot of uncertainty for some of these tech giants. Of course, the advertising market is a key one for companies like Facebook and Google. For Apple, it's how many people are going to buy new smartphones. For Tesla, it's when can the factory reopen. Elon Musk still in a dispute with county officials here in California. He thought the factory could reopen in Fremont, but then the county said, no, not yet. You know, why are we seeing tech rising despite that? I mean, one of the biggest tech ETFs, QQQ, reached a major milestone this week.
I'm so glad that you mentioned that. I keep hearing that when we're all stuck at home, tech is actually the products that we're actually using. So it does make sense on that basis to see why tech is outperforming. You talk about Tesla, people wanting to go back out and drive cars. Uber, people wanting to get back out there. Netflix, for example, which was frankly a lot better than people feared it would be because we are at home streaming. Disney falls in that camp. You talk about the Shanghai factory, or the Shanghai, I should say, park, which had a sold out number when they said that they were going to open up that Disneyland. So you do have tech, perhaps of all those things that we're actually using when we're stuck at home, clearly the outperformers. You mentioned that milestone, QQQ crossed the $100 billion market cap. Back in 2000 in the dot-com bubble, it was a $20 billion market cap. So look at just how far we have come in the past 20 years. Also notable, CQQQ, that's the Chinese gauge of those technology stocks. Also, one of the big outperformers this week, that is actually also outperforming the QQQ index as well. So you're seeing a really broad-based rally, both with the US stocks and the Chinese tech stocks, really leading the way throughout this entire bounce back from those lows of March 23rd.
All right, Bloomberg's Taylor Riggs in New York for us. Taylor, thank you so much for breaking it down. Now I want to bring in a tech veteran, John Maeda of Publicis Sapient, the Chief Experience Officer there, also former president of the Rhode Island School of Design and a design partner at Kleiner Perkins. John, really curious to get your thoughts on just how hard this is going to hit the tech economy. We've got Airbnb, a company that's laid off 25% of its workforce, Uber laying off 14%, and it sounds like there are going to be more layoffs there, Lyft laying off 17%. I mean, just how many more large chunks of Silicon Valley companies are we going to see just get wiped off the map?
Well, I think this is this awakening of realizing that Silicon Valley isn't just full of robots, it's full of people. And if you remember Brian Chesky's essay on Medium in 2013, it was "Don't bleep up the culture." He was talking about the importance of people and not computers in a server room. So I think that this awakening that computation involves people is now quite front and center.
I wonder, though, does that make Silicon Valley companies more vulnerable? These are companies like a company like Airbnb, which has delayed going public, taken on more and more funding, and then used that funding to hire more people and invest in the long term. Right now, those sort of long-term, more experimental projects, that's what's getting cut right now. And I wonder if that means that some of these venture-backed startups, and Airbnb is beyond a startup, but some of these venture-backed companies are actually a little bit more threatened right now.
Well, I think they're threatened if their cultures aren't strong. When you think about Airbnb's culture, it's carefully crafted. It's almost artisanal. So I think it'll definitely weather the storm. But looking at Silicon Valley as a whole, we want to consider how with higher unemployment from tech workers, we'll probably see a whole new wave of startups emerging in the next 5 years that have much more empathy for people who are out of work. That's going to be a whole different kind of startup, I believe. It won't just be a startup founded upon the idea of faster laundry or faster pizza. It's going to be quite more profound, I believe.
So what does that mean for the gig economy? I mean, what do you foresee?
I foresee that the idea that the simple problems can be made into startups are going to be more about difficult problems. How to manage your unemployment situation, how to actually survive is going to be the basis of a startup, and I think that's going to be much more profound.
Now, your research really focuses on the relationships between humans and machines and humans and technology, and I wonder if there are certain trends that you see accelerating, given that we're all working from home, given that so many of us are still sheltering in place. How does the ratio and the relationship shift over that time?
Well, I think that we all know that contactless is like the thing. But if anything, we're learning so much from China. I'm so glad you mentioned QQ and other Chinese companies. When you think about it, we've become more like China in terms of how the internet has come into our lives. And so we have a lot to learn from China's innovation patterns.
So what are the opportunities you see in technology? What are the trends that you think companies and the people who work at these companies should be doubling down on right now?
I think we should definitely doubling down on how we make systems out of data. If anything, when we look at why the tech sector is doing well, it's because never before has it been able to acquire so much data about our lives because we're sheltered in place. It's a perfect petri dish to understand us. And so there's a kind of a scary side, but also an opportunistic side to kind of take advantage of everything we know about people and make better products to serve us better.
Publicis Sapient is a company that helps companies make the digital transformation, get to that digital future. What are the biggest pain points you're seeing for various organizations right now, and how well are they rising to this challenge?
Oh, that's the question that's on the top of my mind. There's that sort of internet joke going around, like who's responsible for your digital transformation's progress, the CEO, the CIO, or the COVID-19? It's this notion that because we have this situation, essentially a power outage of the entire world, every company that held back its efforts to go digital now realize it should have gone digital. So it's all opportunity right now for the established companies to actually up their tech game, whether that's remote collaboration or new ways to do e-commerce. And so that's an exciting time now for those companies to actually catch up.
All right, John Maeda, Publicis Sapient Chief Experience Officer. John, always good to have you on the show. Thank you so much for stopping by.
Thank you.
Coming up, we're going to hear about Google's relief efforts during the pandemic. Where are they putting the money to work? We'll speak to Google.org's president up next. This is Bloomberg. Google.org, the charitable arm of the company, is doling out another $50 million to COVID relief efforts, bringing the total to $100 million. Joining us now on the phone, we've got Jacqueline Fuller, president of Google.org. Jacqueline, thank you so much for joining us. Google and Alphabet have a number of initiatives on the COVID-19 front. Talk to us about where the money is being allocated and how.
Absolutely. Well, look, there's some good news in this moment, and that is that there are innovative nonprofits and universities, social businesses all over the world with really clever ideas on what we can do to stop the pandemic and address the economic devastation. So Google.org comes alongside of them with funding, with technical expertise from our Googlers to help make their ideas a reality. So some of the areas that we're working include health and science. As an engineering company, we're really committed to help getting better data, better analytics, better mapping, economic recovery as well. Super important that we immediately get direct cash to individuals, that we get digital skills scaled. And then areas like distance learning. We've got 1.5 billion learners around the world who can't physically get to school. So we're thinking about how can we support platforms like Khan Academy or Donors Choose, who are reaching teachers and parents and students in this moment.
You've also got Google employees embedded in some interesting places like Boston Children's Hospital. Tell me about that.
Yeah, look, our superpower as Google.org is not only the $100 million that we can provide, but our Googlers themselves. So we send teams of engineers and product managers and UX experts, and they go out and work full time for our nonprofits and our researchers that we're partnering with. So with Boston Children's University in Oxford, for example, they are figuring out how to use data analytics and machine learning to map the spread of COVID in real time, and that is helping to inform on, hey, what are the best approaches? What is actually working to help stop the spread of COVID? And in particular, the Googlers are helping them to take a prototype platform, a research platform, and actually make it scalable and robust and resilient, and make sure all of the data that they're gathering is made available to other teams of researchers and governments around the world who can really also create other mapping solutions based on that data.
Now, you were also the former Deputy Director of Global Health for the Bill and Melinda Gates Foundation. We know that Bill Gates has been concerned about an outbreak like this for some time, but unfortunately governments were still caught off guard. This certainly gives you a unique point of view. What populations are you most concerned about? Like, who are you most worried about getting hurt by this pandemic?
Well, as a philanthropy, we want to particularly pay attention to those who are most vulnerable. You know, we are looking at people and communities who were marginalized and underserved even before COVID, because those are exactly the same groups that are being hardest hit both by the pandemic itself on the health effects, but also the economic devastation. So, for example, just right in our backyard, you know, our headquarters is in the Bay Area, and we saw such economic impact even locally with our neighbors in our backyard. So we teamed up with Give Directly, for example, because we know that providing immediate direct cash during a crisis can be phenomenally helpful. So we wanted to make sure we got $1,000 to families that were in desperate need. So, for example, these are families where 80% of the recipients were women, 41% single mothers, and 79% reported not having enough money or food to last for more than 3 days. So partnering to immediately get economic relief, but also looking at longer-term economic recovery options.
Right. The economic devastation, I know, is only just beginning to be felt. Meantime, Google has told employees that the majority of them should expect to work from home through the end of the year. You've got the president pressuring states to reopen now. Why is Google taking a more cautious approach?
Well, look, we were one of the earlier companies, part of the group of tech companies who actually started working from home earlier than the order went out. And our philosophy is that if we can work remotely, if we can work from home and help take some of the pressure off, help flatten the curve, then we're going to do that. So we will be going back to the office. We will have some of our workers who absolutely need to physically be on site be going back. But it'll be very gradual, and we'll be using, science to guide us in our decision making about how quickly we go back.
So how are you handling this with your own team as you work from home and understanding the science? What is it that you're concerned about? Are you concerned about a continued health and safety risk?
I got to tell you, my team at Google.org, we are absolutely motivated in this moment because we feel like we can help be a conduit to help bring resources, $100 million, and also our Googlers, to people on the front lines who have really great ideas. So as much as we're all bearing some of the impacts personally and having friends or family members who are coming down with COVID, definitely had team members who have faced loss in their personal lives with family. We also recognize this is an unparalleled moment where we can all come together and build solutions at scale and be part of a global community of response. And that's super energizing as well.
All right, Jacqueline Fuller, president of Google.org, thank you so much for stopping by and sharing your work with us. Really appreciate it.
Thanks so much, Emily.
Well, Peloton coming up and proving that stay-at-home fitness is here to stay. We'll speak to our own Mark Gurman about that up next. This is Bloomberg. Peloton is proving that some at-home trends are here to stay, and one of them might just be at-home fitness. The company's quarterly revenue soaring 66%. Peloton also raising its forecast. I want to bring in Bloomberg's Mark Gurman, who covers Peloton for us. And Peloton is an interesting one, Mark, because we keep asking this question, well, which of these trends are actually going to live on out of a pandemic? But here you have people investing in, a couple $1,000 bike, which is putting some money down, and you wonder if that gives this trend itself more staying power.
Yeah, that's a good question, Emily. I mean, I think that their CFO on the call earlier this week made their position pretty clear. They have about 2 million of their products in use, and if you look at their major geographies globally, that, is equivalent to about 90 million gym subscriptions. So they believe that they have a long runway ahead of them, and they also believe that even though we might be, nearing the end of the pandemic in some regions, psychologically, life is really never going to be the same for many people after this, even if gyms do reopen.
Personally, I've experienced the beauty of, 5, 10, 15-minute workouts, family workouts that I never would have done while I was commuting to work. That said, we've also heard anecdotally some people think they could buy these bikes and maybe return them. How big a risk is that to the company?
Yeah, no, that's definitely a potential risk. All depends on, their local return policies. Obviously, there's the sense of maybe these hold, particular value. These things are really hard to get right now because of the supply challenges raised by COVID-19. So perhaps there's going to be a resale market developing for these things as well. One interesting thing is that they're making more money than ever now on subscriptions for different classes and different fitness-based programs they have online through their bikes and Apple TV apps and different software they have, that a lot of their users are on month-to-month plans. So by being on a month-to-month plan, there's obviously a greater risk of people leaving the plan, rather if you're on a 6-month or 1-year type of upgrade cycle.
What does this mean for the competition? I mean, there are a lot of different models out there. ClassPass, for example, that works with gyms, but has pivoted those gyms to provide virtual Instructions. That's the company that's had a lot of layoffs. And I wonder if there's just some sort of reckoning in the fitness industry in general as a result of not just the pandemic, but the success of Peloton.
Yeah, I mean, Peloton is, more and more, in my experience, becoming sort of a brand name. It's almost becoming sort of the Kleenex, if you will, or Xerox of fitness equipment. And so I think their brand is super strong. Their liquidity is strong. The credit line they talked about is strong. You've seen their share price really grow and their market cap grow. So I think they're going to be here to stay. I don't completely agree with the notion that they're going to continue at this level of growth as they have during COVID. But I think there's going to be some sort of meet in the middle realization where, Peloton will be stronger than it was in the past, but not as strong as, perhaps a gym at this point.
All right, Mark Gurman now covering Peloton for us. Thank you so much, Mark, for your insights there. All right, coming up, the pandemic has made the Instacart shopper an essential frontline worker. How the company is grappling with new challenges and new opportunities in the midst of COVID-19. That's next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang. The toll the virus has taken on the U.S. workforce is staggering. More than 20 million Americans losing their jobs in April alone. But White House economic advisor Larry Kudlow thinks job losses will be, quote unquote, temporary and expects a significant bounce back as we come out of the pandemic. He spoke with Bloomberg earlier today.
This is a tough time, but it's a tough time for everybody in America. There's no question about that. Wherever you work or don't work, it's a tough time. This jobs report today is full of heartbreak. It's full of hardship. I believe that it will prove to be temporary because I think the pandemic contraction or the contraction in the economy caused by the pandemic, COVID-19, will prove to be temporary, and that we are actually coming down the home stretch in terms of reopening the economy. But it's a rough number. There's no question about that. Some of this looks to be temporary layoffs, maybe about 3/4 of it, but that still doesn't necessarily make it any better. People expect to return to jobs. Let's hope that they can return to jobs. Look, we have done President Trump's leadership, Vice President Pence, we put together enormous rescue package, cash, liquidity, Federal Reserve, payroll protection. It's a remarkable thing. I was actually adding it up. It's about $9 trillion now, including the Federal Reserve and what we've done on fiscal policy in the budget. Some of this may have worked. We may have cushioned the decline. That may be part of the story inside these very, very difficult numbers. So we will see how this works, and we will see whether we have to go back. Let's talk about presidential policies in a few moments, because I do believe the second half of this year, according to the CBO and private forecasters, the second half is going to have very significant bounce back in economic growth, and that will head into 2021, which could be a fantastic economic recovery year.
When it comes to reopening, I want to understand, and I know you're an optimistic man, whether you've done any contingency planning for a second wave and another shutdown. Are you doing that contingency planning now?
Yes, we are, as a matter of fact. It's a subject that comes up. I'm not going to go into detail. It's outside my lane. You have to talk to Ambassador Birx on that, Dr. Fauci and Vice President Trump's terrific team. that he's assembled. I will tell you this without naming names, but one of the senior people in that group, I asked that person, what happens, right now the virus numbers are flattening out. That is a really good thing. That means we can reopen this economy. So I asked this person what happens if you get a jump back up in the virus numbers, and the response was simply, look, we won't have to re-shut down because, first of all, we know more, we have more experience, and second of all, we are much better equipped with the right tools.
Are you rethinking again your relationship with the Chinese Communist Party?
Well, I don't think we ever stopped thinking about it, but all I'll say is this. First of all, as you know from reports today, Ambassador Lighthizer, Secretary Mnuchin met with Vice Premier Liu He of China. It was a very constructive meeting. The printout, the communique, if you will, was very positive. China continues to tell us that they have every intention of meeting the requirements and the implementations of the deal that was signed formally last winter. Seems like 1,000 years ago, but it was actually only a couple of months ago. They're a little bit behind on commodity purchases. That may be a function, of course, of market and economic conditions. But Liu He said they are pledged to continue, including, I might add, remedies for intellectual property theft and related measures. So those talks seem to go well and were constructive. However, the Chinese relationship is very complex. And we know that the virus originated in China. We are investigating, we, the U.S. government, the intelligence agencies, National Security Council, State Department, etc., are carefully investigating what happened and what didn't happen, what may have happened and what actually happened. China has been not transparent. A lot of people are concerned. I saw this with the president at the G7 video teleconference meeting a couple of weeks ago, and the other world leaders felt the same way. They will be held accountable, Jonathan. They will be held accountable when the final studies are in.
White House Economic Advisor Larry Kudlow there. Well, the pandemic has shuttered businesses all over the world, and as people began to fear for their health, businesses like Instacart went from luxury to essential. But with the crush of demand has come the struggle to keep up. Joining us now, our Bloomberg reporter Ellen Hewitt, who wrote the cover of this week's edition of Bloomberg Business Week. Ellen, thank you so much for joining us. There are a few different stories going on here. Obviously, you've got the need for this service from people who are shut in. You've got the workers on the front lines who are complaining about their safety and lack of benefits. And then you have the company that has been stepping up to meet the demand. How do you reconcile those different stories, and where did you land in terms of just how well this is going?
I think my take on this all is that Instacart has been facing, this enormous surge in demand for their business, which has been a blessing and a curse, right? They, for the first time, turned a profit. That's almost unheard of in terms of these gig economy companies, these fast growth startups. So they earned $10 million in April. Of course, they're unsure if they'll continue to do that in the future, but it's a huge milestone for the company. That being said, I think the intense surge in demand has put into sharp relief their somewhat tortured relationship with their contractors. This is a workforce that, before the pandemic was around 180,000 contractors who go into stores and shop and deliver your groceries. They are planning to add at least 500,000 people to that workforce by summer. They've already done 300,000 in the last 2 months. That has been an intense change for these workers, many of whom are new to the job. It's not an easy one. You have to carry a bunch of stuff. You have to find all the things in the grocery store. You have to figure out how to best manage all these different jobs on the platform. And they're seeing that in response to, these workers are all of a sudden essential. They are feeling empowered to say, hey, we're not being treated correctly. We don't have the correct protections to stay safe while we're doing our job. So they've actually had 2 different labor strikes in the last 2 months from workers who are fed up saying, we deserve better. So it's been a very tumultuous time for Instacart.
Meantime, you've got the company saying, well, we're doing this, and this to protect these workers. In your reporting, did you conclude that the company is doing right by these workers or has a lot more work to do?
It's really hard to say. There are, I have to imagine they're trying their best, but there are also, I think, pretty legitimate complaints coming from shoppers who say, look, for weeks we were being told to do our jobs in areas like grocery stores, which are tightly packed, full of things that people are touching. They're doing these jobs to help other people stay safe, but Instacart was not sending them hand sanitizer or masks. I talked to one worker who said she ordered hand sanitizer from Instacart. It didn't come for 2 weeks. In the meantime, she was doing work for Instacart and ended up using hand sanitizer that she got from DoorDash and Caviar because they were the ones who were actually delivering something. She says she got a new order from them every week in the mail. So I think, I'm not a supply chain expert. I'm sure there are reasons why it was difficult to procure this, but I think shoppers on the ground are feeling pretty abandoned, feeling like they're doing work that is dangerous and essential, and the company is telling them they're doing these things, but they don't always come through in a way that's actually helpful.
Interesting. Well, certainly something to think about. I know a lot of people planning to do their shopping this weekend and try to beat the line. So, Ellen Hewitt, thank you so much for your reporting there. It's certainly a story we'll continue to follow. Coming up, with the unemployment rate skyrocketing, layoffs across the tech economy and the gig economy in turmoil, we're going to speak to investor and media veteran Gary Vaynerchuk for his perspective next. This is Bloomberg. Back to our conversation about jobs, the big question remains just how much more economic fallout will there be? Joining me now, Gary Vaynerchuk, CEO of VaynerMedia, an investor across so many different kinds of companies. Gary, always good to have your perspective on the show. We are looking at major economic devastation here. Airbnb laying off 25%, Uber laying off 14% and more to come, Lyft laying off 17%. Just how many more layoffs will we see, and just how hard do you think this is going to hit the tech economy when all is through?
I think what's really interesting is when you double click into some of those businesses and others, I think people are thoughtfully taking advantage of this situation. Maybe that's emotionally difficult to hear given the pandemic, but I'm sure everybody watching this network is aware that businesses are navigating through their business needs. And I think that you still may see more to come as people try to really right-size their business. As you know, Emily, growing up, being in the ecosystem I was in that Web 2.0 and watching all these companies grow, a lot of them had their economics a little bit upside down and needed to be more profitable than they actually were. And I think they're taking advantage of this moment. Some need to do it to stay alive. Others, I think, are actually just setting themselves up for a brighter future.
Right. So I wonder, are VC-backed companies more vulnerable because they take on all this funding to invest in the long term and run on such slim margins or even losses, and then something like this happens and, all of these employees have to go?
Yes.
So let's talk about retail, because you obviously have you have your commerce business. You launched Vayner Commerce, and retail has been really hard hit. Of course, a lot of shopping has moved online, but I wonder and assume that there's less shopping in general because you've got 33.5 million Americans out of work in just the last 7 weeks. How are you advising your companies, and what trends are you seeing when you zero in?
It's a game of haves and have-nots. Food, beverages, alcohol. There's a lot of sectors thriving as the consumer behavior has shifted in-home, and restaurants on premise have been affected, obviously completely 75 to 100% declines. And then there's obviously things like clothes and other accessories for your car, or things of that nature that have been hit hard. So the navigation's been pretty scattered. Obviously, there's a ton of our clients that are quadrupling down. You have an overlay of ads on Facebook and Instagram and TikTok going down because of this. And so there's a huge opportunity. I wish people were spending less on e-commerce, but I'm sure you've touched on this subject. It was devastating for me to see how much uptick there was in e-commerce and DTC activity as soon as the stimulus checks hit. This is a capitalistic, materialistic society. And some of the people that needed that $1,200 the most literally spent it on a hoodie and a bottle of champagne the second they got it. And so, I don't know, it's going to be interesting, the long tail, but right now we're in a big world of haves and have-nots.
Now, your company, VaynerMedia, is a modern-day media and communications holding company, and if anybody was built for the quarantine era, it is you, because you have been so far ahead in some of these ways to communicate digitally. What trends are you seeing that you believe might be accelerated in media and communication as a result of the quarantine and the shelter in place and this extended work from home, which you've got Google and Facebook telling employees they're working from home till the end of the year?
It's a great question. There's a lot of things. First, to your point, and we're grateful for this, some of the biggest Fortune 500 CPG and other brand-oriented brands are really taking a second look or tripling down with us, because now people have to worry about where their dollar has been spent. And there is an ungodly amount of money being wasted on programmatic digital banner ads and pre-roll ads, and even a scarier amount of money being spent on network television commercials. And so I think what you're seeing people have the time to get educated. I've been on the phone with so many of the CMOs of the companies that are scrolling through your network all day long with stock prices, and they're rethinking their media spends. They're starting to understand some of the things that we've been trying to say, because they have actually the time right now, believe it or not, to double click and get into the details of some of these things. So I think the long-term effect is, I think with the growth of OTT, as a parallel other trend on top of the acceleration of people becoming more comfortable with digital, I think you're going to see the acceleration of the decline of upfront media buys in network television and bad digital executions. And I think the winners of that are the Rokus.
All right,
Hulus,
Gary Vaynerchuk,
Amazon.
CEO of VaynerMedia. Gary, thank you so much for joining us. Always good to have your perspective here on the show. Now, still ahead, yet another gaming company reporting record-breaking numbers in the midst of the pandemic. We're going to speak to the CEO of Super League Gaming, Ann Hand, about esports coming up. This is Bloomberg. Yet another gaming company reporting record-breaking numbers in the midst of a pandemic. Earlier today, I spoke with Ann Hand, the CEO and chair of the esports company Super League Gaming, about the activity they're seeing. Take a listen.
One of my favorite stats about April is that we had about 205 million monthly views across our digital esports viewing channels. In the entire year of 2019, we had 120 million. So that kind of explosive surge, it's a dire time, and yet it's a real silver lining for our company, because we're getting really to a point of real critical mass in our platform. We've also seen an increase of registered users on our platform, up 65% since December.
Now, I spoke to the CEO of Zynga yesterday, and they also had a record-breaking quarter. But I'm curious, when life returns to normal, if life returns to normal, what does that mean? Does business dip, and do the trends, regress essentially?
Yeah, I think it's a really fair question. I get asked that a lot by our investors as well. The first thing I would start with is the fact that gaming pre-COVID was already bigger than TV. It was 3 times the size of the global film box office. So it already had become the dominating form of entertainment for Gen Z and millennials. And so in some ways that trend had already established itself and was very rooted. I'm sure we're all going to jump on our bikes or run out of the house, right? Just anything to kind of solve for cabin fever. That said, because gaming is a dominant form now of entertainment pre-COVID, we really don't see any real changes in the type of engagement we're gaining in our platform. The nice thing is as I mentioned earlier, we're getting to this interesting place of critical mass. where we're building pretty extensive community and rich content for viewing on our platform. And as players engage more, the platform becomes more sticky. So we think that this is a real opportunity for Super League to kind of break out of the pack and really be a permanent fixture in these gamers' lives.
Now, live offline sports aren't happening right now. And there's another question. Once we start playing football and basketball and baseball again, does that also impact your business?
Well, again, all those things existed pre-COVID, and gaming was still bigger than any, professional and recreational sports league out there. When you think about the fact that there's 2.6 billion gamers on the planet, what I'm excited about with Super League is we've always been about the mainstreaming of esports. We've always been about recreational esports for all. These games are now being designed to naturally have competitive structures in them, teams and leagues. And so while there's about 10,000 or so professional esports athletes around the world, we felt like the everyday gamer would want their chance to join a team and have that kind of amped up competitive challenge. And then the other neat thing that's happening is Super League has a very unique kind of secret sauce. We don't just run tournaments. We have a fully remote virtual broadcast capability. And what that means is that we can also create really compelling content for viewership off of these tournaments. That technology is now giving us an opportunity when live sports are on hold to actually start providing fresh live stream content to media outlets that are thirsting for that content. And what I am more excited about than anything is the way that we can produce esports competitions, but do it as an extension of a traditional sport. So what I mean is, Madden tournaments. So the everyday NFL fan can watch a virtual football game, or World Golf Tour owned by Topgolf. It's a video game for golfers, but how fun that it can really be a real legitimate replacement if the US Open and Masters are on hold.
So you said you're looking for new revenue opportunities in existing live, fully remote production capabilities. Is that what you're alluding to here?
Well, right now we have already been doing some things for professional esports teams. We're giving them a way to engage with their fan base. So we've done an exciting production deal with Gen G. And we are in talks with a lot of traditional sports teams and leagues who are asking the question, how do I stay connected to my fans during this time? The other neat thing about the production capability we have is we can actually bring the audience into the experience. So instead of cutting away to a baseball game but not seeing anyone in the stadium, we actually have technology where we can have thousands of people simultaneously joining an experience virtually. We can even get into doing game shows. I mean, the applications are endless. It's kind of a fun little moment for us as an early stage company. Sometimes you build a piece of technology for one use, and then all of a sudden an opportunity arises for it to really have a much broader application. Early on, we designed this technology because we wanted to make the big screen in the movie theater come to life and be immersive and interesting to family and friends who were there watching their gamers game. And that little piece of technology and the patents that we filed around it is now becoming a real solution for not just sports leagues, but wider entertainment and media content.
Ann Hand, they're the CEO and chair of the esports company Super League Gaming, echoing what we've heard from a number of different gaming executives this week, including the head of Microsoft Xbox, the CEO of Zynga, the CEO of Electronic Arts, all seeing the surge in activity. And the big question is, what happens in the new normal? How does that impact the activity in the business that they're seeing? That's a trend that we will continue to follow. That is all for this Friday edition of Bloomberg Technology. Stay tuned to Bloomberg Television. Wall Street Week starts next. I'm Emily Chang. This is Bloomberg.